The U.S. inflation number coming in fairly mild, although people are warning about the reliability of the data. David Sekera joins us now, Chief U.S. Market Strategist at Morningstar. David, always great to see you. Thanks very much for giving us the time.
Oh, good morning. How are you doing?
Very good. So you say these numbers, provided the economy is soft enough, give the Fed justification for cutting rates again?
Yeah, I think really when I'm looking at the Fed and their numbers, I think that the numbers that come out today from the CPI really supports the Fed's projections, in which they most recently decreased the rate of inflation that they're expecting in the U.S. for 2026. So, of course, they're going to be data dependent, but I do think that gives them the green light to be able to cut the Fed funds rate even further next year if needed, if the economy weakens, if the job market continues to slow as well. Now, having said that, I know Morningstar's U.S. economist is still concerned that inflation, could tick up higher in 2026. Still some concerns that some of the tariff-related issues, still might flow through next year, although they're looking for much more moderate inflation in 2027, and thereafter. So I think while the Fed, may, have the room to cut if needed, I think they're probably going to be on hold more likely than not. I think at this point, looking at their projections in which they expected the rate of inflation to slow next year, they also bumped up their GDP expectation to 2.3% from 1.8. To some degree, it looks like they're projecting a Goldilocks environment for the U.S. economy and for inflation. So I think they're probably going to be on hold more likely than not until June of next year. We're going to wait until the new Fed chair takes over in May and see where policy is going to take us after that.
Let's get to your views on AI, because you have a couple of tech stocks that you guys like. So you're saying, obviously, don't give up potential for upside in AI, but be ready for price swings?
Exactly. When I'm looking at 2026, I expect to see a really high probability that we're going to have a lot more volatility in 2026 than we did in 2025. So I almost want to have a bit of a barbell or balanced portfolio, going into the year. So you definitely need to retain some of the upside from AI and from the tech stocks, but I think you also need to have some positions that are more defensive in nature to be able to balance that out against that elevated volatility. So when I'm looking at, AI and AI-related stocks, no one's going to argue valuations are very high. I think you need to have the base case or better play out in order to be able to maintain these types of valuations. And as you saw today with Micron numbers, very strong coming out this morning, even stronger guidance. AI here in the short term can still surprise, to the upside. So I think the real key is going to be at the end of January, beginning of February. That's when we get all the hyperscalers start to report their earnings for the year. But more importantly, watch their CapEx guidance for 2026. The market is certainly looking for them to continue to keep increasing their CapEx guidance. So it's going to be a matter of whether or not they can increase that CapEx guidance on data center build out and AI to really make the market happy. If not, I think we could see a repeat of, early this year when we had, the big sell-off in January and February. Of course, that was exacerbated, by the Liberation Day, tariffs as well. But I really think that when I look at the number of risks for next year, there are a lot more risks that could play through that could keep volatility high over the course of the entire year, whereas here in 2025 we had that big bout of volatility at the beginning of the year, but then pretty much for the rest of the year it's just been up and to the right.
One idea that you have, a tech-related idea, is ServiceNow. You guys see promise in that stock. Remind us what they do and why there could be upside here. NOW is the symbol.
Yeah. So when I'm thinking about, the AI trade for 2026, I think that to some degree, while there are still some hardware names like NVIDIA that our analyst team believes are undervalued, I think the market is probably going to start shifting its focus away from, the hardware names into those companies like the software companies that are going to be able to incorporate AI into their own businesses, into their services, provide more economic value to their client base. And that's going to help them drive top line growth. These are also companies that can use AI within their own business processes to be able to drive efficiencies, to be able to get more and more operating margin over time. So in this case, ServiceNow is a 4-star rated stock, trades at a 25% discount to fair value. It's a company that we rate with a wide economic moat, meaning we think they have long-term durable competitive advantages. And this company has been, in fact, all the software companies have been pretty soft this year. I think there's a little bit of a disagreement in the marketplace about how much AI may actually displace some of their business versus how much AI is going to actually enhance their business being used as a tool. So in this case, this is one of these companies. We think it's going to be a tool in order to help them. It's been one of the fastest growing large cap software companies over the past couple of years. You're looking at 20% type 5-year compound annual growth rate, earnings growth rates of 23% on average over the next 5 years. So this is one that we think we have a differentiated opinion from the marketplace. And I think once the market starts to focus more on some of these software companies, these are very well positioned for the upside for next year.
Okay, ServiceNow. We were having a bit of trouble with that chart. Sorry. Clorox, classic defensive stock. Bleach, we all need it. You see promise here.
Exactly. So I like the consumer defensive sector overall. Now, it's interesting that the sector trades at a very high premium over a composite of our fair values, but that valuation is skewed higher by Walmart and Costco. Those are two stocks we think are actually significantly overvalued. They trade at like 45 and 50 times, PE ratios. But within the sector, if you strip those out, the rest of the sector looks very attractive. Clorox, for example, is a 5-star rated stock, trades at a 37% discount to our fair value. It has a nice, healthy dividend yield of 5%. Again, another company we rate with a wide economic moat. It's had some disruptions to its businesses over the past couple years. More recently, we saw some customer pull forward. They were transitioning to a new ERP model. I think a lot of their customers, bought inventory ahead of that just in case there could have been, any kind of disruption to their underlying business. So when we're looking at, their comps going forward, we think they have some pretty easy comps in 2026 that they'll be able to beat. And utilizing that ERP, we're looking for some margin improvement over the next year, getting back more towards historical norms. So while we're not projecting anything heroic on the top line, I think that operating margin improvement at such a deep discount to fair value is a good, attractive opportunity in today's market.
David, thank you very much indeed. David Sekera, Chief U.S. Market Strategist at Morningstar.